Okay, let's get to the longer term crash warning indicator. So a couple of things to talk about. First of all, the reason why I use the SP contract for looking at commitment of traders data is that the E-mini has become basically the day trading vehicle of choice, and so all the long-term position taking is being done in the SP commitment of traders markets, but the E-mini market is simply a day trading or a very short-term swing trading market. So you'll see the E-mini kind of commitment of traders numbers flip around a great deal more. Now what I've plotted beneath here is just the straight beta commitment of traders indicator, which is just the percentage of open interest that the professionals are net long or net short. On these previous charts, I actually flipped these numbers upside down because I find them more helpful. For example, let me just show you on the weekly chart of the SP. I find it more helpful to see them kind of flipped around, and you can see how the commitment of traders markets indicator here kind of follows what the market is doing. But that's actually an inverted signal here. On this chart here, we've got the straight numbers not inverted. So if it's above the zero line, then the commitment of traders showing the professionals net long. If it's below the line, they're net short. Now, a couple of things to notice. In 2000, this market kind of fundamentally changed. We could see that leading up to 2000, so the commitment of traders numbers became available about 86, 87. So this is when the first numbers were available, and actually they were fortnightly numbers that came out initially. It's only kind of later that we've had kind of weekly numbers on the SP market here. So you can see up to 2000, in general this market was heading up, and the commitment of traders showing the professionals were net long during that period. But since 2000, the market has been kind of really net shorts, kind of below the line over this time. And I want to kind of explain my hypothesis why I think that is the case. In particular, you can see during the run-up in the market into the 2000s, you can see the professionals were net kind of long. They kind of came off a little bit as we went into those kind of record highs, but they were net long. And then during the tech wreck, so from 2000 to 2003, you can see they were net short. What's interesting is since the 2003 bottom that we had, with the second rally, this is kind of commodities boom. We had kind of Web 2.0 kind of coming along here, and we also had the growth of the builders here into 2007 here. The market was kind of advancing, and yet the commitment of traders were negative, were net short over this period. When the market kind of fell off with the global financial crisis, you can see they did go net short, and then since then we've had some periods where they've been net long, but mostly been net short. What I think fundamentally happened during this time period was that we had in September of 97, we had the E-mini market launch. And let me just show you a couple of charts here from the website, Emini-Watch. So this is the article, What are the E-mini futures? Here are the facts. And you can see that this is the monthly volume of E-mini futures since the launch in 97 here. And you can see the first 3 to 5 years up to about 2000, 2002 here, very small volumes. All of a sudden, 2002, this market just took off like a rocket. And basically, it was a little interesting kind of retail market until the professionals said this is a great market. We've got kind of fully electronic market. Even though it's a fifth the size of the SP market, we can still trade in size now. This thing starts to take off in terms of volume. You can see this is a chart comparing the open interest adjusted for the relative size. So the SP market, the SP contract is 5 times the size of the E-mini market, the ES market. And you can see in 2007, 2008, this market kind of flipped over. So this was the growth in the E-mini in terms of open interest, and this is the decline in the SP market, kind of the being traded, and they kind of flipped over. The E-mini became the largest market and it's because of the day trading volumes. It's become the most important kind of day trading vehicle. So this time period between 97 and 2002 is really important here. So between this launch of the E-mini market and 2000, 2002, I think there was a fundamental shift, and all the momentum trading went out of the SP market into the E-mini market, and the SP market simply became a hedging vehicle after that for long-term plays. And so, although we can still see patterns in the way the markets were being traded, just be wary of that. That I think that was a shift that was happening over this time period here, and that's why the E-mini market, the commitment of traders on the SP market has looked fundamentally different than it did kind of pre-2000, particularly during these periods of rallies and declines. The raw number itself, I think, is less important. Kind of the more important thing is the relative number, and that's why for me the divergence signals are important. So that's something that's kind of happened fundamentally. However, I do think you can start to see patterns, and this is why I've just made a small change to my commitment of traders crash indicator that's kind of interesting. And let me just show you how that indicator works. Let me bring up this chart here, commitment of traders 2. And just a note, so last week the warning using this kind of slightly adjusted little piece of code has just gone off, and it's a very simple, I mean it's 3 lines of code, so it's not kind of something that's kind of been optimized. I'm just looking at one particular pattern on the E-mini, and let me just show you for example during this time period here since 2009 to 2010, this rise here, how the market kind of goes. So mostly what I'm looking for is the market is making new kind of 52-week highs here, breaking out to new highs. During that time period, a lot of hedging is going on by the professionals. You can see they're net short and increasing their net short position. So as the market rises, they're increasing their hedging activity. At some point though, the market starts to break away into a real kind of little bit of a runaway move, and they start decreasing their hedges. They start needing to basically cover because they're kind of coming out of the market is accelerating faster and moving faster away than they expected it would to go. So you see the hedging activity kind of start to reduce, decline, start to cover their hedges until you reach some kind of topping out pattern here where they've actually gone net bullish, positive, as we've kind of come into those highs, and then all of a sudden they start to say, no, actually we think we're overextended here. We've kind of been forced to follow this market a little bit, and I've kind of started to lose my confidence in the market, and they start to go net short here, and that's what the warning signal shows. So in this rise here, new 52-week highs being made, the professionals are increasing their hedging, so they're increasing their shorts here, but then as it races away they start to have to cover those shorts and get kind of thinking that the market is starting to break away into a lot higher levels than they were expecting, so they're covering their shorts until they go a little bit net long there, you can see there, and then all of a sudden at that kind of almost exhaustion point they're saying, no, we've kind of gone too far, we need to reverse and start getting short. And that's what triggers this warning signal here. And so that's what we've had in the last few weeks here. We were kind of going up into this new 52 weeks highs, we were increasing the short positions, then it started to go a lot further than the professionals thought. They started reducing their shorts, then went net long 3 weeks ago, and then last week they kind of decided to go net short, and we've had kind of weakness from there. So that's what that warning signal is based on. The crash indicator here, I've just used normally crashes are 20% market declines from the highs, and a correction is usually 10%. I've just used 10% here as a mark, so is the correction from the recent high of 10%. Crash is easier to write on the chart than correction. It was just shorter, so just kind of neaten it up. On the indicator I can change that to 10 or 20%, but I find 10% corrections are pretty important, and that's really what these kind of warning signals are showing. So let's go back over time and just show you some of these other type of warning signals. So this is the last 3 that we've had since 2009. Here's the period from 2005 up to 2009. You can see we had a crash warning here. Didn't lead to an immediate correction. In fact, we had quite a long period where we kind of continued to make a very kind of untidy move up to the highs until we then had a move down. This wasn't a 10% correction, but it was a fairly sizable correction. Then coming into 2007, 2008, you can see the warning signal there definitely went off, almost kind of hit the highs, and then we've had a 10% correction. We then recovered to make new highs, and then made another 10% correction that kind of kept on going into the financial crisis there that we've had leading into those lows 2009. Prior to that, so in the run-up after we had the tech wreck kind of bottoming out 2003, we had a warning about 2004, couple there, and then we definitely led to some kind of weakening over that next 6 months or so. Didn't end up being a 10% correction at that point, but did actually end up to weakness over that time period. Then leading into the highs of 2000, you can see we had a couple of places. This around 97. This is around where we had kind of the Asian contagion. Warning signals leading into a quick crash there at the end of 97. Then in 98, we had again warning signals leading into another crash kind of later in 98. And then leading into 99, we had an early signal here and a latter signal here that did kind of work out. And then leading into the tech wreck kind of crash, we had another warning signal and crash signals here. We kind of had an initial crash. This was a 10% correction here. We made new highs, and therefore we made another 10% correction here, which eventually led to that kind of tech wreck that ended up bottoming out in 2002, 2003. Then prior to that, around the 90s, we had 96. We had some warnings there. Led to some weakness, didn't end up being kind of 10% correction, but certainly a market that was very kind of volatile and unstable. And then if we continue kind of going back, this is a signal that happened in 89 that led to crash in about 90. Again, super early in terms of that, but we never kind of broke those highs at that point. And you can see the data ended at this time period was fortnightly, and you can see each of these kind of 2 bars at a time are exactly the same readings. That's when the commitment of traders numbers were actually kind of coming out on a fortnightly basis. And then the market with commitment of traders numbers kind of being released, I think the back history 86 is about as early as it goes. Someone who probably knows more about the history of the commitment of traders numbers will know more, but that's certainly in terms of the data we have here. I mean, this is kind of the early days in terms of the S&P futures market. Certainly this was 10 years before the E-mini market, and so there was a warning at this point here, but it was based on some, I think people were just getting used to what you could do with a futures contract. Was kind of early days, so people were kind of experimenting at that point. So that's kind of a little bit of a spurious point here, but that's the crash that we had in 87 there. So there we go, a little bit of history, and that's the latest kind of crash signal. I'm got to put a caveat on this. I find the commitment of traders numbers, I used to follow them like a hawk several years ago. I find it less and less interesting. I'm more concerned with my day-to-day trading. The long-term picture I find is fascinating, but I don't really factor it into my kind of long-term view of what I ought to be doing with my investments and in general life. But in terms of day-to-day trading, it doesn't impact. I mean, I'm just looking for 1500 tip bar chart kind of moves. That's all I'm looking. So, but I'm putting this up because it is interesting. It's kind of simple indicators. Simple is best in terms of what's going on, and the commitment of traders has less value in terms of what I do today, but it's still out there as a data point. So let's try and make some use of it at least. I think for me the divergence patterns are more kind of important, show what's kind of going on, but I think it's interesting it's kind of come up at this kind of level, and with the timing of all the other kind of bearish things that I'm seeing in terms of the market, it's kind of an interesting kind of alternative data point. So there we go. I hope you found that interesting, and looking forward to next week's trade.